I am so happy to be here. Thank you all for having me. I love Philadelphia. I'm here a good bit. I'll tell you a little bit about my background, but I have a really strong affiliation with Jefferson, so I love Philly. I am from Baltimore, so I love Philly, but only so much. I don't know if this is me or can you all hear me okay? This keeps going in and out. I don't really need this, but for whatever. Couple of thanks just in terms of notes. Sal, Kim, and Kate, thank you so much. And I would just say, as someone who does this a lot and interfaces with a lot of folks that are involved in corporate development, these folks are great. Kim has done a great job. So I don't know where Kim is. She might not be in the room right now, but anyway, thank you to Kim. I have to say something about Philly sports. I'm a big sports fan. Wow, Philly, right? It's like, what the heck is going on? I'm not going to talk about my '83 Orioles winning the World Series, and I was looking at, and I'm a big NFL guy. I was looking at the number one. I hope the Phillies keep going. What a series, by the way. Phillies and Padres. Way to shake things up. It's going to be very exciting. Eagles are 6-0. The Eagles, right? 6-0. So there's a very good chance Eagles are 10-0 when the pack comes in. I think the pack comes in Thanksgiving weekend, and I've heard that Santa Claus is already preparing the snowballs with the rocks for Rodgers. So, get ready for that. That should be fun, that juice snowball. I am going to talk today about private equity. I call this friend or foe. You'll see sort of where I fit into this thing and the side of the fence that I'm on. But I think the difference in this discussion is, it's pretty interesting. It's along the lines of what was just said in terms of, for such a huge industry, right? So healthcare, $4 trillion domestically, 13 to 15 trillion, right? If our healthcare economy were its own country, we would be what? Fifth largest. Our health economy would be the fifth largest country in the world. California would be 6 until they separate, by the way, but that's a different discussion. Massive industry. I'm going to talk a lot about the dysfunction in healthcare today, but you sort of wonder, why hasn't there traditionally been more injection from private investment, right? And are you guys hearing me okay? Because I keep this, okay. Why hasn't there been more injection from private investment, right? So you think about historically, and I'll just distinguish between venture capital, which was mentioned. Venture capital is really funding early stage companies. Private equity funds more growth stage companies, which is, private equity got its roots in doing leveraged buyouts. Remember Michael Milken and Drexel and all of those folks that were, using debt to lever purchasing companies and driving growth in those companies. But historically, private equity has not played a massive role in healthcare. So there are a couple of reasons for that, I think, and we'll talk through that more as we go. One big reason is that 90% of the US hospital beds are owned by what? They're owned by profit health systems, right? So there's been historically sort of this Chinese wall in terms of, okay, what can we really do or not do? Now, as you all know, I'm from Baltimore and I have an affiliation with Hopkins, and Hopkins is not for profit, but it is not for profit, right? So that's a little bit of a joke. It's a tax status thing, but the reality is we've had some natural barriers that we'll talk about. So what I want to do is talk a little bit about what I'm hoping to achieve with you all today, or hoping that you achieve with me, which it's an open question as to whether this can happen or not. We'll do a quick quiz and then we'll talk about it. And the way I like to set this up is, I want you to be thinking about this through the lens of, if you were an investor, okay, what would you be thinking about? In other words, is healthcare attractive or not attractive, and why? Okay. There are lots of reasons why the healthcare story, the sort of, dysfunctional healthcare story, makes it very attractive for investors, which I hopefully will opine on. I want you to think about it in that context. I also want you to think about it in the context of what we call, or what I call, strange bedfellows. In other words, how things might change in terms of our conventional wisdom about private equity and healthcare and what might happen moving forward. And I'll give you some stories there. And then I'll talk a little bit about how we might be ready to go. Just to give me quick, by a show of hands, I know a lot of attorneys, right? Attorneys, so I can't do any attorney or not many attorney jokes, right? But a lot of attorneys here, show of hands. Attorneys. How many hospital or provider folks? Plan folks? Plan, okay, all right, great. Other healthcare operators? Great. Long-term care, what are you doing, ma'am? If you wouldn't mind sharing. Oh, okay, great. Patricia, what's your business? You are. I love FQHCs. All right, I'm going to talk more about FQHCs, okay? What FQHC are you with? Wonderful. Thank you for coming. Okay, so here are the goals. Let's talk about the private equity client, why healthcare is attractive or not attractive. And again, think about this through your lens and through the lens of an investor. The goals and motivations of private investors. There's a so what. So, okay, great, Don, you can spew all of this stuff, but what does this really mean, and implications and opportunities? And just by way of background, I always get this wrong. Like, I have massive ADHD and I'm not medicated. So, hopefully I can stay on track. I've never spoken on any topic for less than 4 hours. So they're asking me to do this in 45 minutes. So I'm hoping I can get done. My wife and I have 6 kids. I'm Irish Catholic and no rhythm. So it took me a long time to figure that out. My wife doesn't like when I say that, but very thankful. So, you get what you get. Okay. So we're going to go through this and we'll see if it's okay or not. And hopefully it'll be okay. But at a minimum, you're going to be probably agitated, pissed off, irritated, maybe provoked, hopefully provoked in a positive way. So takeaways in terms of, at least if I were sitting there knowing what I know, here are my takeaways for you in a sense. Okay. So number one, healthcare is dysfunctional behind. I'm not going to belabor this right now. I'm going to talk about it. I'm going to make my case and we'll see if you agree with the case. There are lots of implications for that. And we're starting to see things change right now. Consumers are becoming more important. Okay. So part of my thesis is we haven't really cared a lot about consumers, real consumers in healthcare for a very long time. Hopefully I'll make that case and you can either agree or disagree. Regulating. So if you think about healthcare traditionally, the institutional players, acute and post-acute institutional players, that's been a very regulated business. And it's been, I would argue, highly protected, right? We use the term moated, highly moated. And I think the days coming, we're going to start to lessen. You know what I mean by a moat? Protectionist moat. Like, why do you have to have a CON, a certificate of need, to put up a hospital somewhere? Why can't a physician own a hospital? I mean, this sort of thing is nuts. Why can't I start a home health business? Yada, yada, yada. Well, these things irritate me as the market guy. And I will say to you, the number one leading indicator of cost in healthcare, in other words, is stuff more expensive or less expensive, is what? What do you think is the number one leading indicator of cost? Place of service. If you tell me where it's done or comparatively where things are done, I can tell you what's more costly by definition, right? That doesn't seem to make a whole lot of sense to me. We don't have a lot of integrated technology. We're going to talk more about that. And there is a lot of capital. And even given the economic climate, there's a lot of capital chasing things. So the idea would be that remedies include, and remember this when we come back, more transparency, less variation. There is a lot of variation in healthcare, okay? And variation, if you've ever taken a statistics class, they say, okay, there's the variation and the variation that you don't know. And a lot of people, when they argue against this, say, well, healthcare, it's a human system business. How do we really know? But the reality is, let's just focus on the variation we know and can manage for and control, and it's still a lot. And then I'll talk more about sovereignty as we go. I should have said my hobby is health economics. 18 or 19 years at Hopkins. I'm the entrepreneur in residence at the Jefferson College of Population Health, which just means that I try to help them sell programs, but don't tell anybody else that. My friend David Nash, long time friend of mine. So I sort of do this, you know, it's a vocation as much as or an avocation as much as a vocation. Let's just do, this is the proverbial icebreaker. Icebreaker, dream maker. I always wanted to do that. You know the Pat Benatar song? I mean, I'm hoping I have a career, but it's, you know, it's icebreaker, not anyway. So you ever see this guy, Hans Rosling? Anybody ever recognize him? Do people go to TED Talks? Dr. Rosling passed away a couple years ago, unfortunately, but a brilliant guy. There are fantastic videos of him on TED Talks and other places. I strongly encourage you to go and look these up. And you know, really storied career. Public health physician, statistician, advisor to everybody and anybody. Co-founded the Gapminder Foundation, which is focused on making data-driven decisions in healthcare. Wonderful TED talker, and he was a sword swallower. Okay, no longer, I don't think, but he was a sword swallower. He wrote a book, that book called Factfulness. He said, the book, my last battle in my lifelong mission to fight devastating ignorance. I highly recommend the book, and it tells, as Melinda Gates said, tells the story of the secret silent miracle of human progress. So there's a little bit of a quiz here. And let me just ask you, and the reason I do this is I'm hopeful. And, you know, part of Rosling's shtick was, heck, if all you do is pay attention to the news, you sort of feel like we're falling off the edge of the earth all the time, right? I mean, it's like compounding, and we don't really understand and level set. And I think there's a story for this taking away today. So here are the quiz questions, and we can just do this informally so you can't really embarrass yourself. In the past 20 years, proportion of world population living in extreme poverty, has it doubled, remained the same, or been cut in half? A, B, or C? Okay, remember your thing, A, B, or C. How many people in the world have some access to electricity? 20%, 50%, 80%. Okay, A, B, or C. What did the number of deaths from natural disasters change? How did they change over the last 100 years? They more than doubled, they remained the same, or they decreased by half, more than half. The answer's the same to each one. What do you think the answer is? C, right? And there's a whole series of these. He had 11 or 12 of these. He would go around the world and survey the, you know, quote unquote, the smartest people, and no one would answer this 11 or 12 question survey correctly, because we didn't really, his takeaway was, we're not looking at data and we really didn't have hopefulness. And so the takeaways for me are, things aren't nearly as bad as we think they are. Like the notion of dentistry without anesthesia, sort of not really a great idea. And by the way, I'm not going to make any comments about centrally planned healthcare in Canada and moms that have to have pregnancies without anesthesia. I would never condemn a centrally planned health economy. So don't think that I would do that, or forcing queues in Great Britain. The good old days really weren't that good. And let's develop a fact-based view of the world. So how is this relevant to what we're talking about today? I would posit one thing is 1965 was a really sentinel time in the U.S. healthcare, in the U.S. What happened in 1965? LBJ, Great Society, Medicare, Medicaid, and everything changed in healthcare since 1965. I would argue that much of our mental model has not changed since 1965. We are absolutely convinced, I'm on the other side of this, that markets don't work in healthcare. Market principles don't work. We'll talk about those things. Investors are betting otherwise. And we are convinced, and by the way, as someone who taught physicians in an MBA program at Hopkins for 18 years, which is great because, you know, we had a cohort program. Mostly our classes were, we'd have a section a week, 3-hour section. And it's great for humility. You get, you know, reconvinced every week that you're the dumbest person in every room. You know, it's really helpful, you know, satisfying when you're with a group of physicians, but have become convinced that patients need some guidance, right? Some broad guidance. So what is the ugly truth? my good friend, ex-CEO Steve Klasko said, and I think this is really true, everything that we take for granted in the 80% of our economic lives, it's not healthcare, 80% meaning about 20% of gross domestic product is healthcare, right? When we think about industry allocation, and the balance are certainly more competitive industries. And Steve argued all of those things we take for granted, things like plug and play, things like consumer sovereignty, things like, a choice, right? Things like variation. Like, how many of you would expect to go to Best Buy and not be sure that that thing you just bought is going to plug into your computer and play, or fit into your computer and play, right? We don't think that way anymore. I think there are some reasons. These are Don McDaniel, like IMHO, or maybe we would take the H out, but how did we get here? We had some sentinel events. We have this, again, a lot of this is a byproduct of 65, but we have this third-party insurance thing, which is really weird, right? So we take the ultimate, receiver, if you will, of care, receiver of services, and we create dissonance. We separate them from the purchase decision. So this would be like, pick your favorite retailer. If you had a 15% copay, co-discount card, okay, when you go to Apple, what does that do to your purchase behavior, right? And that's a little bit of a simplistic view of the world, but the reality is there's a lot of truth to that. The Great Society created Medicare and Medicaid. I would argue that Medicare created the sovereignty of CMS as the regulator. I've argued for a long time that payment in our system is the regulator. If you're a provider, you look to how you get paid. It defines who can do what, where they can do it, how they can do it, how often they can do it. Every year you're beholden to changes. We don't really do this in any other industry, be overly prescriptive. The fourth party, it be like employers have been largely complicit. We will see if employers respond. We still have 50% of our insurance marketplace is employer sponsored. We still have that massive thing. But again, we have this unique thing in the US where we have, employer sponsored insurance is tax advantaged, which is, or tax benefit, which is a little bit different. And government is about 50% of all healthcare in this country. So we have to consider all of those things when we think about this. So we're at this point where we've had these, I think we have these intractable problems. And if you recognize this acronym PEST, it's one of the tools that you use when you're doing like a macro environmental analysis or macroeconomic analysis of an industry or whatever the case may be. What are the mores? These are what people call exogenous factors. These are things that act upon us that we can't control, right? But think about when you're doing strategic plans, like, oh, I better understand upcoming legislation. I better understand the role of technology and how it's changing. I better understand social changes and how they might affect purchasing power, right? Et cetera, et cetera. So there are a lot of these intractable problems that are tied. I'm not going to spend a lot of time on these. And some of these charts are a little dated, but the reality is I don't really have to change the dates because the truth is more amplified in most cases than it was on the chart. So I'm just going to go through a couple of these things that I think sort of in the amalgam add to the problem. And remember, when I say problem, think about the opportunity if you're an investor, right? Or a partner of an investor. One is significant spending growth. We had a little bit of an abatement of spending over COVID. We had a little bit of an abatement of spending probably 15 years ago in the mid 90s. Remember Ira Magaziner and Hillary Clinton and Jackson Hole, we had some year-over-year flattening of spending, but the reality is our healthcare system has grown fairly consistently, somewhere between 4 and 7% per year for a very long time, and we don't really see that end now. Certainly, we don't see that coming to an end anytime soon. So this is a problem because of what economists call crowd out. I mean, the reality is we are already making choices and decisions about other economic activities because of the cost of healthcare. Some of these things we may not be fully aware of. This is a little hard to see. This is the eye chart, but this is our ranking. So these are two public health indices, 17 high-income countries ranked by life expectancy at birth for males and females, and we're 16 and 17 respectively. So just to level set on this, we're spending somewhere in the neighborhood of, don't hold me to this, $12,000 or $13,000 per capita on healthcare. We're twice as much as the next closest OECD developed country, probably Germany. So we're spending 2x, and we're getting very sort of middle of the road, come see, come saw public health outcomes. I'm not arguing this is the panacea, but this is an issue. When employees say, I haven't gotten a job raise or an increase in a long time, a lot of times it's because they don't understand what's really happening. So you look at this, oh, well, maybe the pointer's not working. Oh, yeah. So up here, just this cluster of things, this is growth in health insurance. And again, dated, but it's actually widening. Growth in health insurance premiums, and 191, growth in workers' contributions to health insurance premiums, okay? And then down at the bottom, guess what these are? Earnings and overall inflation. Now, I have to take a shot. If we looked at inflation, I'd be like that, right? But anyway, that's another day, another discussion. But what does this tell us? Guess what? People are getting increases. It's called health insurance, right? And imagine if we had a different system where we paid people and health insurance, that cost was a part of wage. Would people act differently? Well, I would argue, yes, maybe so. And, maybe not, but very significant. The cost now, even in a small firm, of family insurance coverage, depending on what market you're in our market, and we're in a small group in Maryland, in our market, I think family is $2,500 a month. Okay, that's the premium for a $4,000 high deductible plan, $30,000 insurance premium, okay? We are facing the most significant, and by the way, the most significant and the last significant growth in aging in the history of this country. So between now and 2032 or 2033, aging, i.e. plus 65, plus 85, plus 100 will hit the zenith, okay? We're aging like crazy. Remember in the 40s and 50s and 60s, when you looked at that Social Security pyramid, every worker that was active supporting one retiree, it was like, I don't know what the numbers are, but it looked like a real pyramid, right? 8 or some people supporting one retiree. That pyramid has now been shifted as we age. This, I would argue, has really deep, really significant implications for healthcare and human services. And this, it should come as no surprise, is a significant focus of investors. Now, I would not argue to you that investors are necessarily always the longest minded folks, right? Particularly PE and so on and so forth. But the reality is these trends are not lost, right? So remember what I said. I said at a time when we know the highest cost of care is place of service, right? Hospital, post-acute, institutional. What are we learning every day? We're learning every day that less and less has to be done in an institutional setting, hospital, post-acute. In fact, and the number is generally quoted about 30%. In fact, what we're learning is it's actually maybe better for a lot of the care traditionally provided in institutional settings be provided in the home and community. That's pretty powerful, right? And then we're going to see this mammoth growth in seniors. By the way, this is not just about healthcare. It's been deemed that the size of the quote unquote longevity economy is about 7 trillion. So when we look at globally, the economic power of 65 plus, it's a massive economic block and growing. And I would argue that they have learned and are learning how to sort of throw their weight around. Now think about this in the context of Medicare Advantage, okay, in the US. So we're seeing Medicare Advantage grow very rapidly. I would argue for many groups, the choice of Medicare Advantage is an economic choice, right? And so I think we're starting to see this play out a little bit. I'll talk more about that in a second. This is important. The entitlements are underwater. All this means is that Medicare and Medicaid are, like they say, the Medicare trust fund. It's not a fund and it shouldn't be trusted, right? So that's the reality. It's sort of a Ponzi scheme. But this is, if you look at the yellow line, that's commercial insurance, and commercial insurance subsidizes the rest of the game. Why is this important? Well, for the hospital folks in here, you would be honest if you said, we don't really like Medicare and certainly not Medicaid on the acute institutional side. That is true, right? But the arbitrage opportunity is for ambulatory organizations to leverage all of this historical spend in Medicare, which has been largely unmanaged. And that's one of the biggest trends that we're seeing drive. Healthcare is not safe, okay? If healthcare, if the airlines had a tenth of the safety record of healthcare, no one would ever get on an airplane. And I used to say, and people thought that's really crude and obnoxious and stuff. I say, well, look, if you want to do something safer, skydive, bungee jump, hell, jump off of a building without a parachute, do anything safer than get admitted to the hospital. But the reality is, what have we learned through COVID? The hospital is the infection factory. And by the way, this is one of these trends where I think we saw it in COVID. I don't think it's going to change. I think there's a lot of pressure on hospitals to convince patients long-term and families that they should be coming back. We have a decidedly unproductive healthcare sector since 1990. Sorry, folks. Since 1990, only 2 industry sectors have had negative labor productivity. What does that mean? As those industries have grown, we needed to add more labor, faster clip of labor growth to support the size of the industry, right? 2 industries negative. One is healthcare. Guess what the other is? Higher ed. So let's pick the 2 duds, right? So negative labor productivity, which means healthcare is a labor business. Think about your investor hat. Think about things like AI and automation and robotics. And wow, if I don't know much about healthcare, but I look at healthcare, I'm like, negative 3% labor productivity. If I put some investment in those places that are, heavily manual and labor intensive, maybe I can generate returns. Well, that's the idea, right? That's the thought. Hospitals are in a tough position. Some of this is COVID, some of this is not. The number of CFOs that have told me, geez, Don, I wish we would have listened to you all and tried to negotiate fully capitated contracts, if you all know that term, right? Prepaid risk-based contracts with payers before COVID, we would be in a much different situation right now because, and I don't want to get too technical, but we saw 2020 medical loss ratio probably in the 70s, low 70s, right? Which means that the plans generated a lot of net income. And they weren't paying people to provide care because people weren't coming to get care, right? So we had all of those issues that were exacerbated. We still have massive labor issues, et cetera, as we know. Marty McCary on the right, Jefferson Medical School graduate, now at Hopkins, wrote this great book called The Price We Pay. We don't understand personal finance and healthcare. We don't really understand personal finance in general in the US that terribly well, but healthcare, it's bad. But basically what Marty did was he went across the country and his MO, anybody read this book, by the way? It's really a fascinating book. His MO was, you read it? I go to the town and what do? I go to the court and I want to find out how many bankruptcy cases, how many cases have been brought by the community hospitals against individuals. And guess what? It's a lot. And what he found was that, healthcare organizations were and are bankrupting people. Half of all bankruptcies are healthcare related. And by the way, I think the number is still that half of the half are people that have health insurance. So you're getting bankrupted even with health insurance. So I would argue that's probably not great. I don't want to get too controversial, but I don't think we're going to see hospitals decide, hey, we're going to reduce costs, we're going to reduce our revenue. And by the way, and if you're from a hospital, I would love to have this discussion. If someone can point in this room to one consolidation of hospital systems that led to cost savings and better outcomes for consumers post-acquisition, then I'll buy you dinner, okay? Standing order right now, I'll buy you dinner. So Robbie Pearl, the former CEO of Permanente, calls it the multi-organ system failure. I'm not going to read all of those things, try to pick up some time, but but lots of craziness. The thing I always love, and I think that sepsis, and it's actually less than 2. Sepsis is an admission diagnosis in less than 2% of all patients that get admitted to the hospital. Sepsis, right? But it's upon death, it's in 17% of all deaths, it's diagnosed. So sepsis is 10 times more deadly, should have an E on that, 10 times more deadly than a heart attack. I don't hear any public program about sepsis. Who's talking about railing against sepsis? That's what we call a hospital-acquired infection, right? Or a hospital-acquired condition. All right. So that drives into this opportunity. So now I want you to put your PE hat on, and I'm going to go quickly. And just to level set, how much time do we have given? We started a little bit late, but did we push it? Can we push it like 5 maybe? Can we go to? Yeah, okay, perfect. Thank you, thank you. All right, so I sort of set the table. So think about this now, you're an investor, right? Or you're wanting to partner with an investor. And by the way, even if you're in a space that's been non-traditional vis-a-vis how you view investors, right? In those partnerships, think about this anyway, revisit this whole thing. There are a number of these mega trends that I think are really changing the game, massively changing the game. And I've talked about several of these already. Aging is one of those. 74 million Americans will be 65 plus by 2030. That's massive. Do you really believe that we are prepared to deal with the implications of a care system with 74 million 65 plus Americans? And we also know that people are not aging, terribly well, right? So that's a, that's a dynamic, or their health status is not necessarily keeping up with things. Consumers want more, right? And some of this is generational, but it's real, right? So consumers want more. Economics, this is a little bit of a nuance, but this is important. You all know in your lifetime, I suspect you've heard of the notion of defined benefit pension plans, right? Where, you got a certain, your employer or government guaranteed you a certain benefit when you retired. And sometime 30 years ago, or whatever the number was, we started to move precipitously from defined benefit, which put all of the pressure on the funder, right, to defined contribution, which is called 401k or something, or should we call 301k or 201k? I'm sorry to say that, but 30% reduction in 401k portfolios in the last couple of months, but we won't talk about that. So that concept is important because think about Medicare and Medicaid. So today in Medicaid, I think, somewhere like 85 or 90% of all Medicaid recipients in this country are in a Medicaid managed care plan, okay? So in most states, those plans are called MCOs, managed care organizations, right? And I think 40 or 42 states have a waiver called an 1115 or 1915 waiver, or there are others. That's from CMS. That allows the state to move their Medicaid population into a managed care population. So let me ask you the question. I don't know, I should know who's here in Pennsylvania. If we were moving risk from a government entity to a private entity, what would that be called? I think that would be like privatizing, right? Privatizing the risk, certainly. MA. Just 5 years ago, we were saying, hey, MA could be Medicare Advantage as a percentage of overall Medicare could be 40% by 2030. Well, guess what? It's like 46% now. 46% now. I think that we could hit 60% Medicare Advantage penetration by the end of this decade. What is Medicare Advantage? It's when the feds hire HMOs to manage the Medicare benefits. And what do they do with the risk? They throw the risk over the fence. They privatize the risk. So at a time when we're still having discussions about, and you'll see where my bleed lands on my sleeve a little bit, but I still hear single payer and all these other things. The reality is we're watching the entitlement programs being privatized. Now, for a much longer discussion than today, and some of you probably know this, that has very profound implications for how the system is organized and how piece parts move around and how investors get interested, okay? More privatization, I would argue, drives more activity. The other thing is we've seen a lot of innovation in Medicare Advantage, so that's important. And then the last thing is technology, and I'm a lover of technology. I would argue, remember back to the labor productivity thing, we have negative labor productivity in healthcare. Well, in every other competitive industry that we live in the US, technology has driven labor productivity. So we've seen technology either enhance labor or replace labor. And it's not a discussion about, replacing humans and all that other stuff. But the reality is competitive industries figure out how to use technology additively. We have not done that in healthcare. We're spending we've spent a lot of money, okay? We've spent a lot of money on these EMR things. How many people love their, well, there's not many providers, but you know, I usually get a big one hand up out of 80 for who loves their EMR, right? It's like the land of the mediocre. It's like Woebegone or something, whatever. But anyway, so think about those. And these factors touch 75% of the $4 trillion spend, right? So we would expect, if nothing else, there would be some disruption, some opportunities. A couple of other things that I think are important. I'm not going to go through every one of these, but the one that I think is most important is the upper left-hand corner. McKinsey wrote a paper earlier this year, probably in March, I can't remember exactly. And they essentially said, look, today, well, the premise of the paper was, come hell or high water, regardless of what we do, $265 billion of spending on Medicare populations that has historically happened in an institutional setting, read acute care hospital or post-acute institution, will now be done in the home in the community. $250 billion that will essentially migrate. If we think about, let's pretend for a second, there's no net new spending. And by the way, I'll make the slides available for everybody, so don't feel like you have to write the stuff down. But $250 billion, if we had no net new spending, we were stuck at 4, we're pushing the water from the acute side, and it's going to home and community. Now think about that. Think about when that money goes to home and community. A, it should be much lower cost, yes. B, are we prepared to manage that cost? Not sure. Manage that care? Not sure. Like, you know, back in the day when I was with the Bond Score Health System, home health reported to me, and I'll tell you, and I'm not proud of it, but here was the discussion at the end of the day. I get a call from the home health leader. Don, we had a problem today. Again today? Yeah, we you know, Mrs. Jones, she's we're providing infusion therapy. The appointment was at 8 o'clock. The therapist showed up at 8 a.m. The patient thought the appointment was 8 a.m. The drugs and the support showed up at 8 p.m. We just screwed up. Well, guess what? That kind of screw up doesn't really happen at Amazon. I hate to say it, I'm not an Amazon acolyte, okay? But that kind of stuff doesn't happen. So guess what my response was? Damn, I'm so upset with you. Oh, by the way, did we bring Mrs. Jones to the ED? Or, you know, is she going to get admitted? I mean, this is the system that we have and the system that we had. Now imagine significant portions of this spend are going to be forced away. I'm not going to say this is like for the faint of heart, excuse me, but that is a massive, massive bucket of spending that is going to get transitioned. Why? Because it needn't, it shouldn't. And by the way, there's a good bit of that care that's probably completely medically unnecessary. So guess what? It's going to move whether we like it or not. All right. The response from the capital folks is number one, which you would always expect it to be, we're chasing arbitrage. What does that mean? Arbitrage is the difference between where the spending is today and where it should be. And the idea is if somebody can challenge that and move the spend down, they get to keep the difference, right? Or keep part of the difference. That's sort of the profit model, if you will. There is a lot of arbitrage opportunity in healthcare, right? The privatizing entitlements talked about that. The focus on location, I think location is going to become even more and more of an issue. That's a big deal. And then finally, and without, you know, it's common knowledge, we do a lot of work. My firm does a lot of work for Walmart Health. You know, these insurgents, there's been a long, really soiled track record of retailers trying to enter and fail and do all kinds of different things. But I'm going to tell you, I think this is really going to change. I think this is different because we've got all of the changes in the demography. We've got all of the changes in the market climate. And we've got these firms, and particularly the Amazon, Walmart, you know, even the drug folks, the understanding of logistics and supply chain. Like when I'm doing strategic planning with a hospital CEO and they says, oh, we have a supply chain issue. Let's go and find, and I know I sound terribly negative, I am, but let's go and find the greatest hospital that does supply chain. I'm like, you understand that's an oxymoron. There are no hospitals that do great supply chain. It is anathema to healthcare. You're not going to find it. Go and find somebody that really understands supply chain. Hire a real professional, okay? This is sort of, people don't really like this. It's offensive. Hey, you're too mean and cruel, yada, yada, yada. Okay, but the reality is the reality. The insurgents have a lot of money. If you read, Walmart just announced a long-term deal, a joint venture with United Healthcare. They had announced a prior deal with Humana. They're going to create joint Medicare Advantage plans with United. But think about this for a second. Walmart, you probably know, and it's going to sound like I'm a shill for Walmart. I'm really not. I'm just like lost in the enormity of the economics and the data. 90% of all Americans live within 10 miles of a Walmart supercenter. I don't know if you know that, but that's true. And every Walmart supercenter that's built, Walmart buys at least the most adjacent 30 acres, if not more, sometimes up to 300 acres, right? Because even back in 1960s, when Sam Walton, by the way, you know the Sam Walton story? You know why Sam Walton started Walmart? Anybody? Anybody know the story? What was Sam Walton before Walmart? Do you know? He was a Ben Franklin franchisee. You know Ben Franklin, you know those, right? So guess what? He had 2 stores, or don't hold me this, 2 stores, 3 stores. He goes to Ben Franklin people, hey, we're doing really well. I want to buy more franchises. They say, oh, we love you, Sam, but we have a rule. You can only own 2 franchises. Okay, well, guess what? I don't want to own a franchise anymore. I'm going to start my own. Wow. The path not taken, right? You think about that. Walmart's within 90% of all of those Americans. They've got this massive footprint. And they're not perfect, and they have a lot of economic issues, but they've got a massive balance sheet. We showed Walmart, you could draw a line. Think about a concentric circle of 1 million people, or let's say, because most of them are rural, let's use a smaller number, 300,000 people that are adjacent to a Walmart supercenter in a rural area. Walmart could literally take 100% healthcare risk for all 300,000 of those people and not affect them adversely economically at all. So the starting point would be, hey, why don't we just take the risk? Because think about what happens then. Not only are they trying to drive the healthcare spend, but at the end of the day, it's about share of wallet. So I think we're going to see these insurgents, okay, introduce a lot of new concepts. I don't think healthcare understands consumer, and we're going to find out what that really means. So the PE response, what has happened? Quickly, massive growth in deal size. This is over 21. Obviously, 20 was an anomaly. But, 100 deal count, 375 deals, 151 billion in deal activity. We're seeing more and more activity focused on healthcare. We're seeing more and more new healthcare specific funds created at a very rapid pace. So private equity firms that are creating single shingle, very focused, sole source healthcare funds increasing because of the opportunity. There are really 3 value drivers, as you could imagine, for investors. So again, put your hat on. I'm going to partner potentially with an investor. We can help improve their strategy, where they invest, and give them a leg up. We can help them, or they are concerned about transactions. So once the investment firm decides, hey, I'm going to go down this path, then they're all focused on targeting and how they can drive target success. And this is becoming wildly competitive, right? But that's the middle of the road. And then they own or jointly own an asset. And then the question becomes, how do they increase the value of that asset that they own? Now, if you're a hospital person, sit there and think, geez, how could I foresee us, or maybe we have started to have discussions, or maybe we have joint ventures with investors. What kinds of relationships could they be? How could we potentially entice value? In other words, don't simply say because conventional wisdom was, we don't work with them, but start to ask this question about how could we work with them potentially. There are also some nuances, some changes in private equity that we're really focused on and thinking about. Number one, massive investment and focus and interest in non-traditional assets. So, we have private equity firms. Our gentlewoman here is from an FQHC. You all know FQHCs, right? Publicly subsidized, 1,375, I think, FQHC access points nationwide, 10,000 locations, care safety net providers. We have private equity firms that are asking us, can you introduce us to FQHCs that are interested in doing Medicaid risk? Because we will backstop, we will de-risk the downside of Medicaid risk. So one of the challenges right now is FQs might be in a position where they could actually manage global Medicaid risk, but they can't take the balance sheet risk. They can't take the financial risk. So I would have never thought we'd see a private equity person say, hey, how do I talk to federally qualified health centers, health center controlled networks or whatever? Very rapid decision cycles. Now, this is cooled a little bit because of the economic climate, but the decision margin is very thin. We're seeing more private equity firms, remember, that have traditionally invested in growth stage companies are finding for either valuation or other reasons they can't find the right assets, so they're actually building things. A number of the private equity firms are joint venturing with other companies to build new assets. What's the focus? Well, a couple of areas that come to mind immediately. Think about anything in the physician practice milieu that's been heavily tied to an institutional setting, but looks like it could be untethered. Okay, think about cardiology. What happened 15 years ago to cardiology? There was a change in the economics in the payment. All the cardiologists ran to hospital employment, and then that started to fall apart. And now you've got private equity trying to sponsor cardiology practices coming out, bundled with an ASC or other, modalities. Think about oncology, which is still a little complicated, but the same sort of kind of dynamic that's happening, right, in those worlds. So what are we hearing and seeing that also affects this? Number one, there's a big push to create more standardization in managed Medicaid, because Medicaid is a states' rights issue and all the states have different views of that. But I think there's a recognition that for Medicaid managed care to really grow, there needs to be some standardization. One big thing that we're seeing, which I think is wild, is, and I just read from your Leonard Davis Institute, University of Pennsylvania, the Health Economics Institute, authored by Zeke Emanuel, right, as the lead author, the suggestion that, hey, it's no longer enough for CMS to strongly suggest or cheerlead folks to get into what we call alternative payment arrangements, right, to move away from fee for service. They believe that CMS, ostensibly Medicaid, but not just Medicaid, other programs, that CMS ought to move to mandatory potentially payments and to eliminate risk-free fee-for-service arrangements. So this could be potentially a massive sea change if we see CMS and CMMI become much more proactive, like they did, if you're familiar with DCE now, the ACO REACH plan and so on and so forth, where they've tried to drive to more downside risk. I think you could see more of that happen in VA and DoD health affairs. I think you could see that happen in other segments that the government touches. So, stay tuned. But I think this is a recognition that, when we see real, and I hate the term value-based care, but when we see real value-based care, we actually see change. When we see this sort of fake, not really, some incentives, we're not really changing things, and the system's not going to sort of change on its own. Appetite, I'm not going to go over this, but I call this the rise of the alt-acute. I'm not trying to incite some rebellion or something. The alternative to acute, right? So think about that mantra of everything that we do today in acute or post-acute, can we do it in the home and community? That's sort of become the mantra of a lot of investors. And this is just quickly on the right. It's hard to see on the right-hand side of this is, let me see. Oh yeah. Primary care physicians in our healthcare system generate in the aggregate about 6%. 6% of all spending goes to primary care physicians. Okay. So guess what? If you want to build a really enlightened primary care organization that really understands the future, right, and wants to drive change, you can't make it on 6%. There's no way in hell you can monetize all of the investment you need, right? You need to have risk. And so one prevailing concept is that the primary care organizations, the primary care investments that are focused on, or a lot of them are focused on, how do we move more risk to organizations that are either primary care controlled or ambulatory, home and community-based controlled? This is a big issue, right? And I tell primary care groups all the time, if all you ever do and want to do, you can talk about value all you want. If the only playground that you step in is the playground of primary care. You're never going to get more than like 8 or 10% of all payments. Never. And when you do the math on 8 or 10%, this is the reason why we have a medical caste system. This is why the primary care physician is never going to make more than 200 grand. They do, but you mean. And why the orthopod has to make at least $1 million, right? We need to change the system. And so investors are thinking about, I just had a call last week about, changing incentives, right? Compensation incentives for primary care. A lot of focus, as I said, on the what I call the insurgents, and they are making waves. You can read about that and you can get the deck. Couple of areas that you would imagine sort of coincide: virtual health, telemedicine. I know there's going to be a panel talking about telemedicine today. Remember, the only reason why we're having this panel discussion today about telemedicine and OIG is because of fee-for-service payments. Think about it. If there were no fee-for-service, if providers were globally capitated, why would OIG wouldn't give a rat's you know what about whether you're trying to defraud with telepayments or not? Because it's on your risk. It's on your side of the fence. The payment is the regulator. So think about all that superstructure. We wouldn't need all these lawyers. Wow. I might not be able to get out of here. We'll see. Digital therapeutics, behavior modification, a lot of behavior mod tools, so on and so forth. Personalized testing, lot of precision medicine, applications, as we know. An interest in health plans. There have been a number of what I would call digital health plans that have been funded. The jury's out. They've not done great. Devoted is one up in New England, Clover in the New York City area. I can't remember the one in northern New Jersey, but the whole point here is that can't we automate and drive data and AI around health insurance? Two other slides. Number one, I think this is an important thought process for investors, and I am worried about this for traditional provider organizations. This could be a dark winter, okay? Could be a dark winter economically. I think that there are, no pun intended, long COVID memories. Like, I think people are going to think long and hard about, do I need to expose myself to risk in an institutional setting that's unnecessary? We're going to see continued pressure on the labor economy. I think Larry Summers is probably right that the only way that we're going to start to stem this inflation in anything that's any semblance of the near term will be with upward pressure on unemployment, right? Which will not be a good thing. So we already have, I took license, fragile gig. There was a gig economy already. I'm not sure people necessarily all want to work, but this is the number one challenge that provider organizations are still having. And then the last one, centers of excellence. That was my Lake Wobegon reference. I think help me out here, within 15-minute drive of this place, how many hospital centers of excellence programs could I go to? 100? A lot. That's a lot of excellence. I think everybody is excellent. Everybody is above average. Wow. Now, if you really want to be an innovative hospital player, do you think, hey, maybe I need to go the other way and become a focused factory? Maybe I should focus on stuff that I could really do well. But that's beyond the scope of this discussion. What's it mean to me? And we're going to wrap up right here. And I'm sorry that we're late. It does depend on your current seat, but I would say now is the time to challenge all conventional wisdom and all orthodoxy in terms of how you think about investment and how you might play with them, right? Because all bets are off, right? And people are interested. If you think about hospital dynamics, physician group issues, right? Heavy subsidies. I think the mean is still $250 per full-time employed physician in a hospital owned practice. How many hospitals own real estate? Okay, now it's up to you, but why would you want to own real estate? And certainly potentially in this climate, why wouldn't you use that? We've done more deals with people like Welltower and others in the last 18 months than almost any other part of our business. Jettison the non-core stuff, focus on what you really want to do to drive that change, right? And then, do you understand the value of the assets that you have? And this is where you almost have to deconstruct or reconstruct. So the component programs that you have that you're offering, what value do those bring in a changing marketplace? I ask everybody, what's your senior strategy? I'll tell you, just real interesting about FQs. So one of the things that I learned a couple of years ago, if you look nationally at FQHCs, the national average Medicare payer mix of an FQHC is about 7%, meaning only 7%. I don't know what yours is. You may not know, man, but only about 7% of all patients seen by FQHCs are Medicare age, 65 plus. And I would argue, and I may be wrong about this, but that is a remnant of historically, FQs have not worked terribly hard to keep seniors in the practice because they felt like once the senior gets the Medicare card, they have more choice, they leave. Now, this is at the same time. So think about that 7%. FQs have the largest, what we call aging population. The population between 55 and 65 is massive. So they sort of, through benign neglect and otherwise, they let this go. Well, fast forward to today, when you talk to FQs, you're like, what's your senior strategy? Really? You need to be able to make money in Medicare, in Medicare Advantage, right? In managing dual eligibles. These are where the opportunities are, where the necessity and opportunity intersection are happening. You better start to think about seniors, okay? And it's like light bulb goes on. And now all of a sudden we've got all of this focus on, hey, we have to develop a senior strategy. Do we have to build new centers? Do we have to do this? Do we have to do this? This is the kind of change thinking. I think we're at this massive inflection point where this kind of activity can be very helpful and thoughtful. And if you think about it through the lens of a private equity investor and that tailwind, I think it can help you think about how you prepare for the future. So anyway, thank you.